Hi guys, in this video I want to go over a report that came out today. It's called the Consumer Price Index Report, and it comes out from the Bureau of Labor Statistics every month. You may recall the Bureau of Labor Statistics is the organization that gave us the unemployment rate. So they actually compile data on prices as well. And we focus in on consumer prices, because these are the prices that pertain to the majority of people. Other types of prices would be prices that government pays for things or prices that businesses pay for things. So we're focused just on consumers in the economy. And clearly we don't want to see prices go up as consumers, right? That decreases the amount of stuff that we can get with a given income. When prices do go up, we call that inflation. So what happened? Well, the consumer price index in the month of June went up 0.6%. Let's take a look at this across time. So this is trading economics, and what I've got here is the month over month inflation rate. And this goes back 1 year. Notice here's your 0.6, and you can now see that in the context of the past year. So that is the highest we've seen. In fact, for the 3 months prior, we actually had negative changes, meaning that prices went down month over month. We call that deflation. That's actually very typical in a recession, right? When you have an economy that is recessed, people aren't spending a lot of money, but yet there's a lot of inventories that are piling up on the shelves of businesses. So you have the catalyst for lower prices, right? I mean, put yourself in the shoes of a business. If you've got all this excess inventory and you're not really able to sell it, what do? You lower prices. And that's what we saw at the beginning of the recession. But now there appears to be a bit of a turnaround, and this could be because those inventories that the firms had have been depleted. They haven't restocked the shelves, but people are still buying stuff. And so that creates a shortage, driving prices up. Remember, prices go up when there's more demand than supply. Prices go down when there's more supply than demand. So what's effectively happened here is the supply exceeded the demand at the beginning of the recession, but now demand is starting to exceed supply. If you extend the time frame even further, you'll notice that we haven't had month over month inflation of this magnitude since 2012. So it gives you some context. But if you go back even further, let's go back 25 years, well, we have seen these numbers, right? Back in 2012, and then back in, you can see the numbers here. We were actually back in 2005, we were up to almost 1.5% month over month. Okay, but this is definitely a very dramatic increase and something to watch closely, because it could be a 1 month thing, right? But it could also be a new trend that's forming. Now, why do we care about inflation? It's important to note that inflation is nothing more than higher prices. That's it. But it doesn't always correspond to higher income. So, for example, let's say you make $30,000 a year. Well, $30,000 gets you a certain amount of stuff each year based on the prices. But if prices are going up and your income stays at $30,000, then you're getting less stuff. So inflation starts to erode the purchasing power of our income. Now, it is possible eventually that incomes do go up with inflation, but it's not a symmetrical process, right? If you have month over month, for example, 0.6% increase in prices, you don't get a pay increase of 0.6. It can take a long time for incomes to catch up with inflation. And that can create a lower standard of living for people. And that's what generally happens. So when inflation goes up over short periods, we see people able to purchase less, and that hurts their well-being. Now, let's scroll down here in the article, and I want to show you some of the details. The Consumer Price Index actually does break down into specific categories. For example, it says that Tuesday's report showed grocery prices rose 0.7%. And that's higher than the overall, right, of 0.6. And then dining out went up 0.5%. And then gasoline prices went up a whopping 12.3%, and apparel, right, that's clothing prices, went up 1.7%. Notice how this sudden uptick in inflation in June corresponds with the removal of lockdowns and the kind of reopening of the economy. I think that fits with what we talked about a minute ago, that demand is exceeding the ability of businesses to supply products. That's creating shortages and driving up these prices. And we might expect that to continue if we ease restrictions without stimulating the production side of the economy. That brings me to the last point I want to make with this, because one of the things you may have already heard is that it's an increase in the money supply that leads to inflation. And that's correct. That does lead to inflation. But it's because of its effect on the demand side of the economy. When the Federal Reserve, when they put more money in the economy, then people get that money through banks, right? The way it works is the banks get the money first, and then they lend it out to you and I, and then we go shopping. And that increases demand. So it's not the fact that the Federal Reserve is increasing the money supply that leads to inflation per se. It's that the Federal Reserve increasing the money supply causes people to spend more money and demand more things. And if those things aren't made, if the production can't keep up with that demand, then prices go up. Again, prices going up are always a consequence of shortages. So whether those shortages are created in specific markets for a variety of reasons, or whether those shortages are created because the government has put more money in the economy and stimulated demand relative to supply, it has the same effect. It drives up prices. We have a recession now, and part of the recession has brought about stimulus policy from the federal government and from the Federal Reserve. And from the Federal Reserve standpoint, that means they've printed a lot of money. They put a lot of money in the economy. They're making loans much more easily available to people. Interest rates have went down, so it's cheaper to get a loan. And people are more likely to spend as a result of it. So that can have inflationary forces behind it. And that's something to be aware of, because we want the economy to recover. We want unemployment to go down. We want GDP to go up, but we don't want inflation. Okay, that's it for this video. If you have questions, please let me know. Thanks, guys.